Hi everyone, my name's Darryl Payne, CEO at As Good as Gold Australia, and I'm joined here this evening by my brother Brian and partner at As Good as Gold. And today this evening, we have a very special guest, none other than the author of The Coming Bond Bubble Collapse. He is the president and founder of Pento Portfolio Strategies. He is a globally renowned economist and has been a regular guest on CNBC, CNN, Bloomberg, Fox Business News, and numerous other international media outlets. Welcome, Michael Pento.
Thank you, Darryl and Brian. Very excited to be on your program.
Good morning, Michael.
Good morning.
Michael, we know that you're a busy man, and we know right now that you've got another appointment shortly. So really appreciate the time that you're spending with us this evening. Michael, just about everybody in Adelaide, which is our residing city, and most cities around Australia, most of our clients have heard our story 1,000 times and they're bored to tears with it. However, they don't know your story, and nor do I. So I'd be really interested first up to find out what it was that interested you in economics to start with, when you developed an interest, and how you pursued that interest over a period of time to reach a point where you are today and the position you're in. So I'd be really interested if you could share that story with us.
Wow, that's a great question. I don't get it too often. I don't even think my wife is interested in how I got started in economics. I'm glad somebody's interested. Well, to be honest with you, I'm just being honest with you, it's because my father had an interest in economics. Okay. And I used to hate when you used to watch something called FNN back then. It was really in the early 80s. I used to hate watching it, but then I realized, this is a really good way to make money if you're smart. And I like the challenge. I guess I'm a competitive person by nature. And if you think that you have the hubris to believe that you could be smarter than the next guy, then this is a great way to compete and to make money. And thank God I've been pretty successful at doing so. I got my first break at a discount broker in the early 90s. I then worked on the New York Stock Exchange for several years in the middle 90s. I then became an independent broker for several firms and a major economist for Europe Pacific Capital and for Delta Global before opening my own shop, my own RIA in 2012. And I built my shop on the belief that global debt had risen to such a level that it was going to have to be defaulted upon. Yeah. And that default would take place either through deflation or restructuring, or through inflation, which is massive debt monetization. Either of those two cases would take place. So and perhaps even both of those cases at various times. So I built my inflation deflation spectrum, and it's been very powerful, very robust, and very, very beneficial for myself and my investors.
Yeah, yeah. Well, look, I wish I had learned what you had learned a little earlier, but fortunately for me, I did come across a gentleman by the name of Peter Daniels, Senior, who happens to be a billionaire in this country, remarkable mentor for me over the years. But he asked me some questions about economics and I couldn't answer any of them. I just didn't understand what he was talking about. And here I am, Michael. Brian and myself had developed an international business. We were represented in 17 countries around the world in the manufacturing division. We supplied standard components to a lot of the major car manufacturers around the world. And I had no understanding of economics at all. So 1997 was where it really happened for me and turned my life around along with Brian. And then we engulfed ourselves in the subject of economics and of course, developed a keen interest in precious metals. Talking on precious metals, we all know that all currencies go back to zero. 5,000 years of monetary history. I think there's been something like 3,800 fiat currencies. None of them exist today. They've all gone back to zero. People like Jim Rickards are telling us that, we were fortunate enough to have Jim in Australia just recently in November last year. That was just a fantastic event. But Jim's talking $10,000 gold. He said, look, it's not if, it will occur. He said it may be through a reset or chaos. It's going to be one of the two. And they're talking $500 silver as well. That's just based on like a 15-to-1 ratio versus where it is now at 79-to-1. My question to you would be, are you confident in $10,000 gold and a reset? And if so, when do you think we might be? When do you think that might be? How far away do you think that event might be?
Okay, well, that's a long question. So let's start with my own estimates. So if you just take the global money supply divided by ounces of gold, I come up with $6,000 per ounce. Dollars per ounce. 6,000. That's my own work that I come up with. Now, what would cause a global reset to eschew fiat currencies? What would cause something like that? Well, I think we're closer than a lot of people may realize. So let's just backtrack a little bit. Let's go talk about the Great Recession and bring us to where I think we could be headed today, as briefly as I possibly can. So coming out of the Great Recession, which was, everybody should know how it was engendered. It was engendered by artificially low interest rates, which created a worldwide global housing bubble, bursted and brought the entire financial system to its knees. And that was because the Federal Reserve took interest rates down to 1% for 1 year. Right. Now, we took interest rates here in the United States to 0% and left them there for 8 years. Yeah. And it wasn't just the United States this time. It was the horrific Bank of Japan, the European Central Bank. Everybody took interest rates to 0 and below. As a matter of fact, at its apex, at the apogee, where there was 14, or I think it was 14 trillion, no, sorry, $16 trillion worth of negative yielding sovereign debt extant in the globe in 2014, circa 2014. And what I find most surprising is that people believe that the central banks around the world could take away their interest rate repression with impunity. That's what I find most shocking. So let's talk about some things that have occurred because of that massive, protracted suppression of interest rates for 8 years. For one thing, global debt rose from $170 trillion worth to $240 trillion worth of global debt. That's a $70 trillion increase in global debt. Well, what else occurred? So you have a massive increase in the leverage ratio extended across the globe. You also have real estate back in a bubble. You also have the stock market. Let's just take the stock market here in the United States. The stock market here in the United States now sits at an incredible 150% of the underlying GDP. That has never before, Darryl and Brian, never before happened. The high point was 148% of GDP. Guess when? In March of 2000. We all know what happened then. A recession, the blow up of the NASDAQ stock market, and stocks gave back, the NASDAQ, for example, gave back 80%. And in 2007, this figure wasn't anywhere near 150% of the economy. So you have, if you look at the median PE ratio, price to sales, market cap to GDP, we have a massive equity bubble, we have a housing bubble, and we have a horrendous and horrific bond bubble. So the bond bubble is going to burst. Now I'm going to say, when I wrote the book, The Coming Bond Market Collapse in 2013. That was a predictive work at that time. No longer predictive. The bond bubble now is in the process of bursting. For example, the US 10-year Treasury was 1.3% not too long ago. Now it's at 3%. More importantly, LIBOR, the London Interbank Offered Rate, okay, so dollar loans over in Europe, which, by the way, is the function, the factor behind $370 trillion worth of derivatives and loans. That went from 0.3% to 2.37%. So the bond bubble is in the process of bursting. And what happens when you have a global, international, worldwide epic bond bubble bursting is you're going to bring down real estate, you're going to bring down stock prices, and you're going to bring down world economies. So that's what's happening right now. Now, on the other side of this, to answer your question, as global economy, as the world enters what I think, unfortunately, and I am not a Cassandra, and I try not to be hyperbolic, I believe we're headed for a worldwide recession / depression. And on the other end of that, I believe we're going to resort to things, central banks are going to resort to things such as universal basic income, NIRP, negative interest rate policies, which is going to necessitate the banishment of cash. Physical cash is going away to be replaced by a global, maybe IMF coin, blockchain based, and helicopter money. So what is helicopter money? It's even worse than the horrific quantitative easings that have taken place all over the globe. Helicopter money goes around the banking system. So in other words, when the US housing market blew up, what happened was, instead of giving homeowners money to make their balance sheets rectified, they took bank assets off their balance sheets. They created money digitally by fiat, by decree, and purchased banks' assets, making the banks whole. And it was up to the banks what to do what they wanted with that money. They could let it lay latent and fallow as excess reserves, which is much as what they did, or they can purchase new assets. Helicopter money circumvents the banking system and directly sends checks to the private sector, which is a massive increase, a massive, humongous increase in the broad money supply, which will lead to intractable inflation. And it is then, so first, let's just backtrack, a global recession, depression, which is combated with one final round of massive intractable global inflation. And then you will see gold and silver shine like you've never seen before.
Yeah, well, I mean, so you're talking a situation that's that could be worse than the Great Depression. That's really what you're telling us.
Well, there's never been a situation like this before. I mean, $240 trillion worth of global debt. That's 330% of global GDP. You've never had the stock market in a bigger bubble. I'm not talking just about the PE ratio, which has been covered up by issuing debt to buy back shares, which boosts earnings per share. I'm talking about median PE ratios, price to sales, and market cap to GDP. We've never been this high in the stock market before. And as the Fed's blowing up the bond bubble, so it could blow up by two reasons, two causes. One, through inflation, and one through the central banks trying to remove their stimulus. Well, both things are occurring right now. So you look here in the United States, the US 10-year note is at 2.95%. Nominal GDP is close to 5%. Well, that's where the 10-year note should be. But, look at the massive increase in debt. The national debt went from 10 trillion to 22 trillion since 2008. So why in the world would you ever expect interest rates to merely normalize to 5%? They should be going much higher than 5% because of the amount of debt. And don't forget this too, Darryl and Brian. Central banks were bidding. They were buying. I think at the peak, they were buying $180 billion worth of assets. So if you add up all the central banks, Bank of England, ECB, BOJ, United States, at the apex, they were buying $180 billion worth per month. It's going to zero. So rather than having the private sector front-running central bank bids, you're going to have the private sector front-running central bank offers. So the bond market collapse. Bond market is going to is collapsing. No longer a prediction. The bond market is collapsing upon a record amount in nominal terms of debt and even in terms of GDP, on top of record asset prices. That is why, again, that is why I believe the next recession is going to be morphed into a depression very quickly. I just want to add one other reason why. If you look at the stress on global balance sheets, so sovereign balance sheets are stretched, central bank balance sheets are stretched, and consumer and corporate balance sheets are all stretched. So there isn't for example, in 2008, the Fed took the Fed funds rate from 5.25 to 0. That's 525 basis points of reduction. If we enter into a recession today, they can take back 175 basis points. That's it.
That's it.
Just not a lot of wiggle room left to imminently bring us back to imminently reinflate asset prices. It's going to be a long, hard struggle that's going to require them to undertake UBI, helicopter money, and NERP.
So it's just kicking the can further down the road all the time. I mean, one would have to ask the question, how long can the facade continue? I mean, surely it's looming upon us right now. I mean, you've already talked about the bond market, but we see the real estate market over here flattening out in Australia. I see interest rates having to go up over the next few months and probably over the next couple of years. And I know that most people are stretched to the limit. If you increase interest rates by 2-3% over the next couple of years, I think it's going to sort out a lot of people, just unmanageable mortgages. So how long does the facade continue, Michael?
Well, right now it's all about confidence. I mean, if you ask the average Main Street economist or the mainstream financial media, everything is terrific. In fact, I heard on the way over here, I was listening to Bloomberg. I was listening to one of the. I don't know if I should mention his name, but maybe I will, maybe I won't. But everybody, if I mention his name, you would know exactly who I'm talking about. Okay, Mohammed Al-Arian. I'll tell you who he is. And he was telling us, everybody, how it's been a glorious removal of central bank stimulus. So there's a tremendous amount of confidence and faith. So what does that confidence and faith in central banks engender and in governments? Well, it engenders faith in the entire fiat currency regime. And I think when that ends, and it will end, if we enter into a recession prior to the Fed getting to 5% or 4%, wherever their terminal rate, well, they have a bunch of models that are all broken. The worst of all is the Phillips Curve. The Phillips Curve model says that too many people being prosperous and working and producing in an economy is the very progenitor of hyperinflation. I mean, it's just nonsensical. I mean, the ignorance and the ignorance that's extant in central banks, I say it respectfully, but the ignorance that's there, their models are, Ben Bernanke told us that once we went below 5% or 6%, that inflation would become intractable, be hyperinflation here. We had to, panic about it. Well, guess what? The unemployment rate fell to 3.9% here in the United States, and we're still struggling, according to the Fed, to increase the employment cost index. I mean, we're still struggling to maintain 2% inflation, which is their god-awful target.
Yeah.
As to why you want to depreciate money at a rate of 2% per annum is beyond belief. As if the economy was only destroying money at the rate and purchasing power of the citizenry at 1%, that would be really a terrible thing. You just couldn't tolerate that. So, but once the confidence in central banks and governments is shaken, then it's all over. So let's just follow out my train of thought here. If we enter into a recession before the Fed reaches 4 or 5% on the Fed funds rate, I don't think they'll ever get anywhere near there. Let's just say their terminal rate is 3.5, but right now it's 1.75. The yield is very important for you guys to understand. I'm sure you do. Forgive me if I'm being
keep going. Yeah.
If I'm talking too much, but the spread between the 10-year and the 2-year note is now 45 basis points. So in theory, 2 more rate hikes is going to flatten out or even invert the yield curve. And once you invert the yield curve, 9 times out of the last time, 9 out of 9, which is a pretty good high percentage, you've entered into a recession. So 2 more rate hikes, Fed funds rates at 2.25, the yield curve inverts, the 2-10s inverts, and then you have a recession really 6 months or so down the road. Then that's when all the confidence goes away. Because right now, mainstream economists, mainstream financial institutions are of the belief that the Federal Reserve can normalize interest rates and the economy can function normally. They're of the belief that the Federal Reserve and central banks can drain their balance sheets and the economy can function normally. Don't forget, over there at the ECB, they're still printing 30 billion euros a month. And Mr. Kuroda over there in Japan, who owns over half of the ETF market and almost every sovereign bond printed at the Bank of Japan.
Pretty much.
Yeah, that every JGB that's printed, they haven't even begun to drain their balance sheet. So if I'm correct, and I think I am, and I use math, and I have math and a process here. So I look at things like yield spreads. I have a complicated model, diffusion index, which measures when the economy is going to a recession. One of those big metrics, one of those big components is the yield curve. And if I'm correct, and if we go into a recession in, say, in the next year, say the yield curve inverts in the next couple of quarters, and then we go into a recession, say in about a year or so, what are central banks going to tell you? That basically it's a tacit admission that, and here, this is very important, central banks can never drain their balance sheet. Central banks can never normalize interest rates. Central banks can never defend the value of their fiat currencies. In fact, they're going to have to step up their depreciation process. So what I'm looking for is a complete evisceration of the confidence in governments and central banks. That's what's ahead. And that's why I think gold, precious metals in general, have such a great future ahead. And I run an actively managed portfolio. I'm not a perennial, perpetual gold bug. So right now my portfolio is only 10% gold, because what does gold not like? Gold does not like a rising dollar, which is what you have right now. And gold does not like rising real interest rates, which is what you have right now. So I'm only 10%. But what you should be doing is accumulating at least a 10%, because gold is dirt cheap right now. And when that recession becomes manifest, you have to load up the truck, load up the boat on precious metals, because they are going to be the primary asset class to own for several years hence.
Yeah, for many years. Yeah. That's a fabulous answer, Michael. I guess what we better do is get on to question 2. Brian, you've got a question you want to ask Michael.
I was first start by saying, Michael, I think we better start looking at getting you into the Federal Reserve. I think we have a lot of action. Okay. I got 2 questions to ask, and the first one's got 2 parts. Well, I hear a lot about the COT report. And I say, looking at the most recent COT report, let's say go back 2 weeks ago, the net silver shorts being the lowest in 25 to 26 years at 3,709 contracts. From your experience, would you suggest to you that would be to see that we will see the best prices for silver since 2011?
Well, I mean, I'm a contrarian by nature. When I hear things like that, I mean, you could make a lot of money just betting against anything that the Wall Street is overweight. So the Wall Street was massively overweight a short on the dollar several quarters ago. That's blowing up in their face. Wall Street, and I wrote a book about this, so I'm just saying that, long term, I think bond yields are going higher, but Wall Street was massively short long-term treasuries. That has been a struggle as of late. It's going to work out well in the end, but as of late. If you hear anything on CNBC over and over again, like how great the price of oil is doing, or if you hear anything on CNBC about anything, or how great Apple is or IBM, just do the opposite, and you'll make a lot of money. So when I hear Wall Street and the global commodity pits are massively short silver, that's a buy signal for me, definitely.
Okay. Great answer. Okay, the second one, this is an interesting one from my point of view, because I love talking about the gold standard. We go back 3,000 years and we talk about it up to what's happening today. So the question is, the last 2 years have seen an increase in paper contracts for trading gold and silver increase it by approximately 40 to 50% each year on the COMEX. So that now, with a trade 75% more gold annually that has ever been mined in the history of the world. So how long Can this fraudulent activity keep going? And is the only answer for the buyer to demand the physical metal?
Well, so first of all, everything is manipulated in the financial markets. Everything. You know, LIBOR is being manipulated. So stocks, currencies. So if you can manipulate all those other commodities and currencies and even LIBOR, why is it a surprise that precious metals are manipulated? They're heavily, probably the most manipulated market out there. I don't think that will ever change, really. The question is, and the answer it in two ways. Number one is, I think that Wall Street just wants to make money. So gold and silver can be manipulated both ways. So I do think it'll be manipulated higher rather than lower at some point in the future, especially after the next recession becomes manifest. And number two, I always believe that you should take physical possession of your precious metals. The majority of your allocation to precious metals should be in your physical possession. And if you do that, that will obviate and preclude much of those shenanigans that take place on Wall Street.
Would you recommend then, Michael, that most of your gold, silver bullion be in your own country, or would you have a percentage overseas?
I would have it not in my own country. I'd have it in my basement. I would have it on my lawn. I would have it in my shed. I wouldn't try. You know. Here's the thing. I never understood this, Brian. You know, if you have a systemic global crisis, do you want to call up Hong Kong and ask them for your gold? I mean, is that someone there going to answer the phone? I mean, I'm just trying to be honest here. I mean, I don't have agenda here at Pento. I don't have any agenda here except to make money. That's why sometimes I have no gold. Sometimes I have 10% gold. Sometimes I have 40% gold. Sometimes I'm short the dollar. Sometimes I'm long the dollar. So I have only one agenda. That's to make my clients money. So my agenda here is not to promote some bank vault or gold vault or any kind of vault. My agenda here is to promote one thing, is to make money. And that means that in a time of crisis, you don't want to fire up your computer to see if you can retrieve a Bitcoin. Okay, when the grid goes down or the internet goes down, or somebody who manages the blockchain tells you that they split the currency 500 times and gives you, bit gold and bit whatever it is, bit cash and all this stuff. You want to have gold, which is real and honest money.
Yeah.
Mr. Morgan was correct. That is in your possession, physical possession, physical gold in your physical possession. That's key for me.
I think our clients will love that answer. So that's a great answer. Okay, one question before Darryl does the next one. Look, the debt levels have increased in the US, as you know, by 10 trillion or approximately since 2008. But do you believe the gold-silver ratio that reached here in Australia at 38-1 in 2011 could be breached to the same level or lower than 38-1, or whatever it reached in the States?
Well, listen, I believe that when you want to overweight silver as vis-a-vis gold is when you have global synchronized inflation and accompanied with global growth. So you think about 2000 to 2007, you had inflation, depreciation of the dollar, and global growth. Since I do believe that we're headed for a global recession, I still am of the belief that that gold-silver ratio will remain wide.
Okay. Even though that Keith Neumeyer said, I mean, he's got a lot of silver mines. He's basically stating with his mines and the peer people that he meets that they're only mining silver at 9-1 at the moment. So you still believe that not going to change, come down lower?
Could go down a little bit, but I don't think it's going to close dramatically.
Okay. All right. Darryl.
Okay. Michael, I noted just recently that the central bank purchases of physical gold increased by something like 42% in the first quarter of 2018 versus the first quarter of 2017. I also note, and I'm not really 100% sure on the numbers here, there seems to be varying reports, but JP Morgan seems to have showed an enormous interest in physical silver of late and have a stockpile, I believe, of somewhere around 150 million ounces. Would this, I mean, surely this is an indication that they know that something is about to happen, and surely they'd be thinking that silver's going to go up, not down. What are your thoughts there?
Well, I do think, where I don't think that ratio closes, I'm bullish on silver and gold.
Yeah.
Well, here, Wall Street operates on insider information. It's always been the case. So, to think about this, I look at LIBOR and there's something called SOFR, SOFR. They want to replace LIBOR with something called SOFR. And why would they want to do that? Well, what does LIBOR do? LIBOR is an indicator that lets you know that there's distress in the banking system, right? So the government knows and banks know. They want to replace with a, SOFR is a secured, LIBOR is unsecured, SOFR is a secured lending rate that's backed by treasuries. Why do they want to do this? Because the insiders, the people in government and the people in big banks understand that the next crisis is coming. It's nigh. It's just over the horizon. In fact, we're in the early stages of it. You look here in the United States, we're in early to mid-May, and all the averages, major averages, are down on the year. This is shocking, given the fact that we have this massive tax cut here and earnings growth above 20%. Why is this the case? It's because the recession is coming. So it's about insider information. Governments and banks understand. They are aware that the crisis is coming, and they are availing themselves of precious metals, gold and silver. And that's particularly acute in Russia and in China.
It's interesting, isn't it? They don't mind having lots of it, but don't want you to have any. It's a really interesting point, isn't it?
Well, it works out great for them because they talk down the price of gold consistently.
Of course.
And they can get it a lot cheaper that way. And once they have their hoard, and the global recession depression hits, they'll fare much better.
Yeah, I like Jim Sinclair's comments when he makes reference to generating wealth and said it's not all that difficult. Just do what the major central banks of the world do. Just become your own central bank. Own gold.
Well, that's what, it sounds very simplistic, but the mantra here is don't fight the Fed. Well, if you're long stocks right now, if you're long global economic growth, then you're not only fighting the Fed raising interest rates, you're also fighting the massive dumping of their balance sheet. So they're dumping $30 billion a month right now in May, headed to $50 billion a month come October. So you're fighting the Fed I think the Fed's the tightest is in the middle of an interest rate hiking regime such as we've never before seen. So they're hiking at every meeting that has a press conference, and at the same time they're dumping in October $50 billion. So this money used to be held by the Federal Reserve, and so the Treasury didn't have to float that to the public, and they were credited the interest back. So now the Treasury has to float that bond to the public at market prices, and they have to pay interest. So this is unprecedented. It's never before happened that we had a Fed funds rate hiking regime at the same time we had reverse QE. So yes, and I want to add this too. If you look at what's going on around emerging markets, it's also not very pretty because the Federal Reserve is hiking interest rates, which is causing dollar-denominated loans in the emerging market space to come under much pressure. So for instance, you have, I believe we went from about 1 trillion of loans to a little over 10 trillion in dollar-denominated debt in the emerging market space since 2008. That's a huge increase in dollar-denominated debt. And you look at a country such as Argentina, they actually floated 100-year. I mean, Argentina, who defaults on debt regularly. It's like Big Ben. It's like Old Faithful here in the United States. They regularly default on the debt, but somehow it was oversubscribed to float a dollar-denominated 100-year bond. Well, their central bank has to raise rates aggressively to defend their currency. The interest rate now in Argentina is 40%.
Yes, I know.
So what happens is to this $10 trillion in loans, you have a choice. If you're Turkey or if you're Argentina or if you're Brazil, Venezuela, If you have this dollar-denominated debt, you have one or two tactics you could take. You could massively increase your interest rates to defend your currency, right? Which will wreck the economy, or you allow the dollar or your currency to depreciate, and that means paying back this debt is impossible. That means you have to default.
Yes,
so your choices aren't too good. So that's why when I said central banks took interest rates, I started this interview off, taking interest rates to 0%, leaving them there for 8 years, causing $16 trillion worth of negative yielding sovereign debt. Never before has happened. And it comes with, it's fraught with risks such as we've never before seen. I'm talking about bond market risks, real estate risks, equity market risks, currency market risks, all of those risks. And you're going to have a major collapse such as the world has never seen. And it's very, very close.
Yeah.
Unfortunately.
Wow. Wow. Brian.
Yeah, Michael, Brian here back again. You've already mentioned it a little bit, but just to clarify, we know that Jim Rickards is a great 10% person with reference to gold, silver, precious metals. You've already mentioned it in this interview, but I did hear, and I watched you about 6 months ago, and you said be ready to hold 30%, up to 30%, maybe a touch more, but certainly up to 30%. Is that time coming soon?
Yes, and I'm waiting. I manage money for a living, so this is what I have to specialize in. After the recession becomes manifest, once it becomes clear to Mr. Powell of our Federal Reserve that he has to abandon his interest rate policy, a hiking rate policy. Once he abandons QT, quantitative tightening, once that occurs, and he will not do that with alacrity, believe me. These people understand that once they abandon that path, that's an admission that the Fed can never normalize interest rates, and the Fed and governments can never allow markets to function freely. That's a hell of an admission, and they have to be dragged into that. But once they do that, the dollar is going to plunge. And I believe it won't be far before real interest rates start to plunge. And that's when you want to be, in my opinion, because I run money, massively overweight gold. And you're talking about not 30, I'm talking about 40 to 45% in my portfolio. Not just physical gold, but I want the leverage of gold mining shares in there too, because they always outperform the metal. So that's when you want to overweight mining shares, which by the way got killed between 2012 and 2015. Precious metal mining shares fell 85%.
Yeah, that was
we're going to reverse that in a huge way once the dollar stops rising and once real interest rates start to fall. And that's only going to happen once what I call the greater recession becomes manifest. And I don't think that's too far away. If you look at, like I said, if I look at things like the yield curve, LIBOR, OIS spreads, many other metrics that I have in my 10-point model, they're telling me that we're not too far away, a few quarters away at most, before we really start to see this economy slowing down. If you look at, by the way, if you look at global PMIs, purchasing manager indexes, you'll see they're already rolling over. And we have peak earnings growth here in the United States. Our ISMs are rolling over. So we're already seeing peak growth, peak margins, peak growth, peak earnings, and peak GDP growth extent all over the globe.
Yeah, so I've just read an article the other day with reference to the automotive in the United States and how Ford especially changing their tune due to the lack of profits. So I think they're going to be making the Ford Mustang and also one other car, and they're going to be into trucks after that. So yeah, they're looking at where they can make money and not lose money. Okay, on to the next question. This is an interesting one, I think. There's an article that I read about the Russian ruble. How much truth is there in the Russian ruble being made from silver or backed by silver? After an article posted by the Silver Doctors on March 20th, Hugo Salinas Price also had an input to this article. What's your thoughts?
Well, as I said before, Mr. Putin is a big lover of precious metals, both gold and silver. And it wouldn't surprise me if there was a silver or gold-backed yuan and a silver and gold-backed ruble. I mean, the trend away from the dollar as the world's reserve currency is intractable. It's happening. It's more and more. The only thing that's saving the dollar right now is growth differentials and interest rate differentials. That's the only thing. So I have a window of a strong dollar that's going to close very quickly and very hard in the next few quarters. So it wouldn't surprise me at all if Mr. Putin and Mr. Xi Jinping was going to follow that strategy of backing their currencies with precious metals.
Interesting. Good. Yeah. Lovely answer.
It's a good way to attract capital, and it's a good way to, if they want to trade oil, and yuan, having an oil, or not only backed in precious metals, having an oil-backed currency too. So that's the trend, and that's a good way to get current, real, going away. This is one of the functions that's happening right now, is the world is going to reject fiat currencies. And if you can back your currency by a commodity such as oil or through precious metals, that's the trend.
Yeah. Yeah. Michael, there's that many black swans out there. When they talk about black swan events that could turn the tide, and Jim Rickards makes reference to the snowflake and the last snowflake that causes the great avalanche. I mean, you look at the world at the moment, Syria, I mean, that could lead to a world war at any time. We have trade wars that have been instigated by Donald Trump, of course. We've already talked about the petro-yuan, debt levels through the roof. I mean, a lot of this stuff that we have talked about already, but you've got, with increasing interest rates, there are so many factors here, so many of those snowflakes that Jim talks about that could set off the avalanche. What do you think? Do you think any of those are going to be, do you think there's going to be a standout component here that's responsible for just a severe breakdown in the economy? Will it be any of those, or is it something coming from left field? What do you think?
Well, I mean, it could be a geopolitical event. It could be North Korea. But I mean, you don't need any of those things to happen.
No.
It's happening right now, which is the normalization of interest rates. If you normalize interest rates that have built record asset prices, that have engendered record amounts of debt. If you think about the tremendous amount of debt, and I went through all the numbers already, that's spent in the global economy, one thing you can't have is rising debt service payments. And that's exactly what you're getting all over the world. Like I said, LIBOR, $370 trillion worth of loans and derivatives, $370 trillion. LIBOR went from 0.3 to almost 2.4%. And it's going higher almost every day. So you don't need a Thai baht crisis, which is very possible. You don't need a Venezuelan crisis. You don't need an Argentinian crisis. All those Russian debt crises, all those things can happen because of the differential rates of central banks and currencies. But the most salient thing out there is the bursting of the worldwide bond bubble atop of global debt, record debt, which has built record asset prices. That's all. It's what's happening. That's all you need.
Yeah. No, it makes sense. From time to, well, I was going to say from time to time, but quite often, I have people say to me, Darryl, the gold hasn't done much in US dollars, right? Because they're constantly referring to it in US dollars or Aussie dollars. It hasn't done too bad in Aussie dollars. Of course, we're only about $50 under the peak price. 2011. And I say to people, look, don't make the mistake of measuring gold in dollars all of the time. Have a look at what you may be able to get in exchange for gold. And it's really interesting at the moment, but you've got Venezuela. I mean, there's a great example. But, if you thought back, say, 10, 15 years ago, right now, the average wage in Venezuela is about $7 US a month, I think, around it. But if the average Venezuelan, and they're dying of hunger, they're malnourished. If you took the average Venezuelan family 15 years ago and they had invested in a gram of gold a month for 32 months, so they bought an ounce of gold, today they would be able to feed a family for 5 years. I mean, that's how powerful that asset can be. What do you think? I mean, I think people get carried away with just valuing gold in dollars all of the time. I think it's what you can exchange it for very often, and that's a great example.
Well, Wall Street is enamored with the value of the dollar, and they say if the dollar goes up, gold has to go down. There is coming a time, and I think it could even be now, where gold rises in all currencies. So that you say the dollar is up or down, you're measuring the dollar against another pair. That's how currencies are measured. Listen, the beauty of gold, the incredible beauty of gold is that it's virtually indestructible and extremely rare. That's what separates it from all these garbage cryptocurrencies. You know, if you look at a cryptocurrency, it was really just 64 electronic numbers and letters. I mean, there's nothing rare about that. Certainly nothing indestructible about that. That's why it's not gold. You know, cryptocurrencies aren't gold 2.0. It's garbage. That's why gold is so rare and so beautiful, and silver to a little bit of a lesser extent. You cannot destroy gold, and the beauty of it is that for thousands of years, you say 3, I might say 5. Its purchasing power never changes. That's why it's money. No matter how you represent it against oil or against fiat currencies, its price might change, but its purchasing power never changes. That's the beauty of gold, and I don't think that'll ever change. And it's the fact that we have thousands of years of history behind us, confidence to say that.
Yeah, 5,000 years is a long time, isn't it? It's got a pretty good track record.
Absolutely.
Brian, you've got a last question there for Michael.
You can't do any better than 5,000 years, that's for sure. But a question that comes up here in Australia, I mean, there's a lot of people that we deal with, Michael, in just selling bullion that have got $10,000 to invest. But there's the ones who have our super funds that they might have 50,000 or 100,000. What would be a breakdown for a $10,000 account in precious metals as against, or does it change for $50,000 or $100,000?
Breakdown between gold and silver?
Yeah.
Platinum? Right now?
Yeah, right now.
I would say you want to be probably somewhere in the neighborhood of 70%, 60-70% gold, say 30% silver, 10% platinum.
Right. Okay. Interesting figures. All right. Last one from me, and then Darryl will be closing. I don't like projections because the manipulation is so heavy that you cannot tell what the crystal ball is going to give you. But if you were, by the end of 2018, under normal situation, what would you expect the price of silver to be? I mean, at the moment, $16.50 per ounce US. At the end of this year, what would you think silver could reach?
Could reach?
Could reach or will? No, I won't say will because there's no way with the manipulation.
Yeah, there's no way, you know. Well, if I'm correct and the yield curve inverts before the end of 2018, which I think it's very likely, and you see come October or November, is for many, many reasons. I think the Republicans lose the House of Representatives in October. There could be trade tariffs imposed by October. The ECB goes from 30 to 15 billion and then announces they'll be out of QE by the end of the year. So there's so many things, a confluence of events coming around October, which could drive the price of silver close to $20 per ounce.
Okay.
Could.
All right.
I'll say could. That's my,
yep.
And then much higher from there. Once the global, I'm going to call it global depression, becomes fully manifest.
Okay.
And gold, by the way, I don't know if you guys also sell gold, but if I could just also gold, I think gold approaches all-time nominal highs by the end of 2019. I think that's a very safe bet.
Oh, interesting news. Okay, Darryl, you take it over.
Yeah, and with hyperinflation, it could go anywhere. We haven't even considered that, have we?
Well, absolutely. If we have central banks reacting in a panic with UBI, helicopter money, and NERP, then I think Mr. Rickards is more correct. 10,000, and that's just for starters. Because not only I do my calculation based on the monetary aggregates that are in existence today. They're going to even broad-based, not just the monetary base. I'm talking about the broad-based monetary aggregates, M3, as measured by private sources, are going to absolutely explode across the globe.
Yeah, yeah. Michael, it has just been sensational interviewing you this evening. It is evening over here. It's mid-morning over there. And we'd love to think that we could do this again. And I'm sure our subscribers and our clients are going to be enthralled in the conversation that we've had with you today. What I would like to do, however, is ask you, because we're going to have a number of clients that would like to contact you for further advice. And so what I'd like to ask you is, how would they go about that? If they would like to know more about what you do, Michael, and how Pento Portfolio Strategies may be able to assist them, what would be the process?
Well, I offer a podcast. International clients is a little bit difficult for me to take on. So I offer a podcast. It's $49.99 a year, $49.99. It's very good. Gives you all my insights, all my research on a weekly basis, called the Midweek Reality Check. My website is pentoport.com. If you want to call the office here from Australia, you're more than welcome. It's 732-772-9500, or you can email me at mpento@pentoport.com.
Fantastic. Michael, this has just been sensational, and to all of our subscribers and viewers, you have been listening to one of the most influential economists in the world, Michael Pento. Michael, we really appreciate your time. It's been a privilege to interview you today, and we look forward to connecting with you again in the very foreseeable future.
It's been my pleasure, my absolute pleasure, Darryl and Brian. Thank you so much for having me on the program.
Thank you very much, Michael. It's been great.